Hello and welcome to Learn Fast with HK. Today we are going to understand the payables turnover ratio and days of payables. This topic is a part of financial reporting and analysis reading of CFA level 1. Before we proceed further, please subscribe my channel for more videos. Accounts payable is the amount of money a company owes to its suppliers. This is the balance sheet item and is shown towards liabilities under current liability. Now let's move on to understand what is payables turnover ratio. To put it simply, it measures the speed at which company pays its suppliers, and the formula to calculate it is total purchases divided by average payables. The average payables is the beginning payables plus ending payables divided by 2. You must be wondering, what if purchases are not given upfront in the accounting statements? Well, yes, you're right, but we can always calculate it by taking beginning inventory, adding COGS, and subtracting what's left with us, which is the ending inventory. This should give you purchases for the year. Let's look at an example to understand it better. Imagine that ABC Corporation reported purchases of $2,000 in the income statement in the year 2019. The beginning and ending payables in the balance sheet was reported as $100 and $900. So the average payables remain $500, and you can see its calculation on the screen. If you plug everything into the formula, the payables turnover ratio comes out to be 4. It is difficult to say whether the ratio of 4 is optimal or not. The best way to conclude it is by comparing it with industry average. Let's suppose that industry's payables turnover ratio is 2. The ratio of 4 is higher than 2. So does it mean that ABC Corporation is doing better? Well, not really. Let's understand it. The payables turnover ratio, which is the purchases divided by average payables, is 4 for the ABC and 2 for industry. If we reverse this ratio, we can find the average payables divided by purchases, or average payables, as a percentage of purchases. That is 1 by 4, or 25% for ABC, and 1 by 2, or 50% for the industry. We can also say that total payables left for ABC are only 25%, while 75% of the suppliers have already been paid. On the other hand, for the industry, it is 50%, which means that on an average, the industry paid off 50% of its payables, while another 50% are still left to be paid. It seems that ABC Corporation is paying off its suppliers faster than the industry average. It seems like a good thing to pay off your liabilities faster, but paying off your liabilities faster also burns out the cash faster. If ABC followed industry standards, it might have more cash in hand and therefore better working capital. On the other hand, paying off the suppliers late may negatively affect the business relations. To conclude, we can say that it is always better to maintain this ratio close to that of industry. Now let's move on to days of payables. The formula for calculating it is 365, which is the number of days in a year, divided by payables turnover ratio. The days of payables for ABC is 91.25 days, while for the industry it is 182.5 days. Once again, we can say that industry is paying off its suppliers in 182.5 days, or 6 months, while ABC Corporation is doing that in 91.25 days. It again points towards faster level of payments by ABC and probable burnout of cash and lower working capital. Both payables turnover ratio and days of payables always provide the same result. Thank you for your time. If you like my video, please hit the like button. For online classes, please contact me at learnfastwithhk@gmail.com.